All right, welcome to today's explainer for August 13th, 2026. Look, if you've been tracking the mortgage market lately, you already know it's been complete chaos, right? We're seeing these brief little moments of relief that are just instantly followed by sudden spikes, and it's leaving a lot of borrowers feeling totally lost. The reason for this crazy environment is something I like to call the global mortgage tug of war. So today, we're going to cut through the noise, look strictly at the data, and figure out exactly what is pulling rates in opposite directions. Here's our quick roadmap for today. We are going to cover the mortgage tug of war, the Fed's next move, geopolitics and swap rates, a housing market reality check, and finally, navigating the volatility. By the end of this, you'll know exactly how to prepare for what's coming next. Okay, Section 1, the mortgage tug of war. Let's start with a quick market overview to establish the main conflict that's dictating the global economy right now. Take a look at the current average for the 30-year fixed mortgage rate. It's sitting at 6.74%. Now, sure, that slight 4 basis point dip from last week might sound like some welcome relief, but we've got to look at the larger context here. That tiny drop, it comes right on the heels of 5 consecutive weeks of aggressive increases. Meanwhile, the 15-year fixed is hovering around 5.97%, and the refinance rate is slightly higher at 6.77%. We are hovering dangerously near year-long highs, and it's entirely because of two opposing macroeconomic forces. This setup right here captures the core issue perfectly. We're caught in the middle of a massive tug-of-war happening behind the scenes. On one side, you got cooling inflation trying its absolute best to pull mortgage rates down. But then, on the exact opposite side, you have persistent geopolitical pressures yanking them right back up. This constant, unrelenting tension between domestic economic cooling and international volatility is exactly what's keeping rates elevated and trapping the whole market in this state of high unpredictability. Moving on to Section 2, the Fed's next move. And specifically, we need to talk about their deep internal division, which is a massive driver of this domestic uncertainty. So the committee is currently fractured into two very distinct camps. On the dovish side, policymakers like Fed Governor Lisa Cook are warning that time might be running out. They're arguing that hiking rates too soon could severely compromise the labor market. And they actually have a really valid point. The July payrolls report just showed a surprise decline of 23,000 jobs, which is the lowest we've seen in months. But on the hawkish side, you had 3 FOMC members who actively dissented in July because they preferred a quarter-point hike. Their argument is pretty simple. Core PCE inflation is still running above 3%, which is obviously well above the Fed's 2% target. This crucial point is captured perfectly by Kelsey Barrow, a fixed-income portfolio manager at JP Morgan. She hit the nail on the head, saying, "A single data point will not dictate the Fed's next move." So even though consensus expectations are pointing to relatively muted month-over-month CPI and core CPI prints of 0.1 and 0.2%, the Fed needs to see a sustained trend. Literally, 1 or 2 good inflation reports just won't be enough to tip the scales if that core inflation number remains sticky. But get this, here is the wild disconnect in the market right now. 81%. Remember that surprise drop in jobs I just mentioned? Well, that actually lowered investors' expectations for a September rate hike down to about 40% from over 50. But the wild card here is that the market itself is still pricing in an 81% chance of a hike at that September meeting. That is a glaring, massive gap between what the jobs data is suggesting and what the broader market actually expects. It just goes to show how volatile this environment truly is. All right, Section 3, geopolitics and swap rates. Let's zoom out to the global level and see how international conflicts translate directly into sudden rate spikes for local homebuyers. To really understand this transmission mechanism, we have to talk about swap rates. Swap rates are one of the most highly influential factors behind fixed mortgage pricing. Basically, here's how it plays out. When geopolitical tensions escalate, like the current conflict involving Iran, oil and energy prices spike. This immediately fuels global inflation fears. And in response to those fears, swap rates experience intense volatility. When that happens, lenders are forced to immediately reprice their mortgages to manage their risk. It's a direct domino effect from global conflict straight to your monthly mortgage payment. To see the real-world fallout of this domino effect, look no further than Rachel Springall over at MoneyFacts. She noted that lenders were somewhat forced to U-turn on fixed rate cuts due to these persistent concerns. And to give you an idea of how incredibly fast this happens, just look at the UK market. 3 consecutive months of mortgage price cuts were completely wiped out in just a few weeks when tensions escalated in the Middle East. The average UK mortgage rate jumped from 5.47% in July to 5.59% at the start of August, a total U-turn driven entirely by global tensions. Because of all this rapid repricing, we are experiencing something the industry calls shelf life shock. Back in July, the average shelf life of a mortgage product, meaning how long a specific rate is available before the lender just pulls it, was 14 days. By the beginning of August, that dropped to just 11 days. Products are vanishing from the market rapidly. In fact, this is the shortest shelf life we've seen since we hit a record low of 8 days back in April. For borrowers, this means your window to grab a suitable product is incredibly small right now. Section 4, Housing Market Reality Check. Let's bring this back down to earth and look at the U.S. market data to see what this actually means for everyday buyers and homeowners. Check out the stark juxtaposition between these short-term weekly bumps and the long-term yearly deficits here. According to the Mortgage Bankers Association, U.S. mortgage application volume did climb a seasonally adjusted 3.6% last week. Purchase applications rose 3% and refinances climbed 5%. Sounds good, right? But here is the reality check. When you look at the yearly column, purchase applications are actually still 1% below this exact same week last year. And refinance applications, they are a staggering 22% below year-ago levels. The true state of the U.S. housing market is that it's still heavily suppressed. So why is refinance demand so incredibly weak? Well, it's because hundreds of thousands of households are facing a looming payment shock. Let's take the UK context for a second. The Bank of England reports that 750,000 households currently sitting on fixed rates below 3% are set to expire this year. When they renew in today's market, they are facing average monthly repayment increases of around £170. That is a massive hit to the wallet. And in the US, we're seeing the exact same dynamic play out. The average revert rate, which is what borrowers default to paying if they don't actively lock in a new deal, is currently sitting above 7%. That is substantially higher than current fixed rates. According to the MBA's Joel Can, because rates are so high right now, refinance incentives have simply dwindled. This has actually caused the average refinance loan size to drop to its lowest level since July 2025, as the pool of eligible borrowers just continues to shrink. And trust me, these trends are absolutely not isolated to the US and the UK. Let's look over at Australia. Mortgage demand is falling sharply there following some recent policy changes. The government recently scrapped property investment tax concessions, and man, the reaction was immediate. ANZ, which is the smallest of the big four lenders, saw home loan applications slump 12%. Commonwealth Bank reported a 15% drop. And Westpac, they saw a massive 20% fall. On top of that, average property prices are down about 2% over 4 months, and auction clearance rates are sitting at 6-year lows. This just proves that global mortgage markets react instantly and uniformly to both policy shifts and geopolitical shocks. Okay, finally, Section 5, Navigating the Volatility. Let's synthesize all this data into some clear, actionable steps for you. Here is your final playbook based on everything we've looked at today. Number 1, volatility rules right now. Geopolitical events can wipe out months of progress in literally just weeks. 2, the Fed is split and entirely data-dependent. Those upcoming jobs and CPI reports are going to be critical. 3, act quickly. With shelf lives sitting at just 11 days, deals are being pulled faster than ever. 4, don't wait around for massive rate drops. Most projections place the 30-year fixed in the 6.1 to 6.3% range through year-end. As Rachel Springle warned us earlier, waiting too long for a miracle rate could be an awfully expensive mistake. And 5, use a mortgage broker. Honestly, with products vanishing this fast, professional advice is more valuable than ever to help you navigate this turbulence. Which leads me to our final question for today's explainer. Are you ready to move quickly? Because look, the underlying pressures of geopolitical risk, Fed uncertainty, and inflation, they aren't going away anytime soon. In a market where favorable deals vanish in 11 days, hesitation isn't just frustrating, it is incredibly expensive. Get your paperwork ready because when that window opens, it won't stay open for long. Thanks so much for joining me for this explainer, and I will see you next time as we continue to unpack the data behind these rapidly shifting markets.